going on, future certified public accountants? Welcome aboard BEC. Let's do it. First of all, I want to thank everybody for joining. All kidding aside, while this is a free event monetarily, we are certainly well aware it's not free in terms of your time. So we are going to use your time wisely here. So we have a good hour, maybe 6. I don't know. We'll see how it goes. But you know, I never go to an hour. That's impossible. So we're going to work a series of multiple choice as well as a task-based simulation. So want to welcome everyone here on behalf of the folks at UWorld. The reason we're doing this, obviously, I've recently joined the team, and it's a phenomenal team. So happy to be a part of this group. And we want to earn your business. Ultimately, you know, Famous Amos gave out those cookies. People had a taste of it, and they were like, damn, that's a good cookie. So we're going to make this a good cookie. So, yeah, folks at UWorld, if you're not familiar with who UWorld is, if you were to Google them, but they are certainly a leader in education technology. They've made a huge investment in accounting and finance, not only bringing myself on board, but they also acquired the Wiley Efficient Learning team. Obviously, Roger, who is by far the best in the business. Couldn't be happier to be a part of the same team as Roger, because him and I for years, you know, grew up in this business together, and I've always admired his work from afar. So I'm glad we get to be on the same team. And then they brought in-house people at UWorld. So really, it's just a great team. And look at this team, baby. What a team. Are you kidding me? So yes, Roger is the man. Now, we actually have one of our folks on board, Jen. Jen, do you want to quickly say hello to the group and welcome on board? I hate to put you on the spot. I don't know if you got your mic ready, but it's up to you, Jen, if you want to say hello.
Hi, everyone. Thanks, Pete. I got myself unmuted really quickly. I think that's a record for me.
Wait.
So yeah, welcome everyone. We're glad to have you. We have a whole team of people behind the scenes trying to answer y'all's questions as fast as we can. Well, we hope to get to all of them. If not, we'll try to answer some live as well. So y'all have fun.
Thank you, Jen. Thank you, Jen. So yeah, great to be a part of this phenomenal team. And I'm talking about people with credentials up the wazoo, people who've actually worked in public accounting for many, many years, big firms, medium size, small size, you name it. But you know, college professors, etc., PhD, and all that kind of good stuff. So really, it's a hell of a team. Honestly, it's the best team I've ever been a part on, and really an honor to be here. So enough with that stuff. Are you guys ready? Let's drill, baby. So I'm going to be putting the question up. I'll give you an opportunity to read it, and then we will go through it. Okay. So the goal is not only to use this question. Obviously, we want to solve it, but the goal is to use the question to review the rule. Okay. So beyond the scope of just that question. So let's do it. BEC Boot Camp, September 9th. By the way, I will get you excited. We're going to be doing another free one, September 23rd. I'll remind you at the end of this, it's going to be a 2-hour boot camp. That's right. We're building mental endurance because, as you know, 4-hour exam, you can't afford to get anything wrong exam day because you're mentally fatigued. So we are slowly but surely going to be building up your mental endurance. So the next one, brand new questions, not part of what we're doing today. Be a 2-hour boot camp, and then in October, and then another one in November. Those will actually be 3 hours, but those will be a combination of some questions you have seen before, as well as some questions you won't have seen before. So yeah, we're really excited, but the next one will be September 23rd. So let's jump in. Let's bang it out. Here is question number 1. So they tell us we're at quote unquote market equilibrium. All of the following statements are correct, except, so we are looking for the false statement is the correct answer. So folks, when I see things like quantity supply, quantity demanded, I'm immediately thinking I want to draw it out. So here's my price, my y-axis, here is my quantity. So here is your supply line, there is your demand line. How do you remember that? Supply to the sky, D in demand, D in downward. So if the government stays out of it, here is our price at equilibrium, and here is our quantity at equilibrium. All righty, so that's what they mean by market equilibrium. Now, more to come on that in a second. There are pros and cons to government action, okay? So, you know, we'll see some upsides and downside, but in this particular question, they're looking for, hey, when you're in market equilibrium, which of these is not true? So A is true. So your quantity supplied equals your quantity demanded. There's not going to be any surplus. There's not going to be any shortage. So that's incorrect because that's a true statement. There's no shortage. There's no surplus. True statement, thus incorrect. Effective price ceilings have lowered prices to protect the interest of consumers. So let's talk about, and I like the word effective. What is an effective price ceiling? Okay, so folks, sometimes a price ceiling is nice, right? Pros and cons. So, you know, we might have rent control. So a classic example of a price ceiling. So government intervention, the government gets involved. So a price ceiling. So I want you to think about prices being kept artificially low. Okay, we want to help people find an affordable apartment. So prices kept artificially low. Okay, so we are no longer going to be at market equilibrium. We are going to move that price to a price point that is below the equilibrium price. So we want to give people an opportunity to find apartments that are affordable. Okay, so now what happens is when we have a change in price, all I did here was change the price. Folks, when all you have is a change in price, the supply and demand lines don't shift. They stay exactly where they are. We slide along the existing supply and demand line. So if we slide along this supply line down here, here's your new quantity supplied at that price. Now, with that apartments being so affordable, quantity demanded has now moved here. So as you could see, the quantity demanded is well above that quantity supplied. We now have a shortage, folks. We are not in equilibrium. Okay, so this is not market equilibrium. So this is the correct answer because this is the false statement. You're not at market equilibrium when the government gets involved and sets a price below the market clearing price. Okay, so with the rent control, the quantity demanded is greater than the quantity supplied. So the good news is if you can find an apartment, it's going to be less expensive. The bad news is it's going to be really hard to find those apartments. Why? Because there's now a shortage. Okay, so there's now a shortage. So that's the correct answer. That's the false statement. Now, what's wrong with choice D? A common wrong answer choice. Price controls, if in place, are not binding. They are ineffective. So folks, you will be in equilibrium if they set a price point that's ineffective. So the difference between choice C and D, like let's say they accidentally set a price ceiling above the market equilibrium price. Like if they put a price ceiling up here, that's going to have no effect because that's above the equilibrium price. And by the way, people who are hunting for affordable places to live, you're not doing them any favor if you raise the price above the equilibrium price. Okay, so that is considered ineffective. So if it's ineffective, we'll still be where? At equilibrium. All right, so at equilibrium, quantity supplied equals the quantity demanded. No government intervention, no shortage, no surplus. So correct answer is actually the false statement, and that is choice C. Now, what I love about the UWorld product is the detailed explanatory answers are out of this world, as you're going to see. All right, so it's not just about saying, hey, the correct answer with a green bar is C. No. They're going to tell you why C is correct, and they're going to tell you why A, B, and D is incorrect. Now, part of what I want to do with you is talk about a price floor, the other situation where you might see government intervention. All right, think about a minimum wage rate, a minimum wage rate. So the quantity supplied of labor, lots of people are going to want to work at that rate. So here's your supply line, here's your demand line, your quantity, your price. If the government stays out of it, here's the wage rate, here's the quantity of labor, here's the price, and we are at our market equilibrium, market clearing. There's no shortage, no surplus, all good. But they say, you know what, this equilibrium wage rate, it's too low. We want to help people out. We want them to have an affordable wage. So to be effective, Where does that minimum wage rate have to be? Above that equilibrium price. So they put a price floor, and that floor, though, has to be above the equilibrium price. Now, all I did was change the price. I made it higher. So we slide along the existing line. The quantity demanded is going to be here. The quantity supplied is going to be here. So now the quantity supplied of labor is going to exceed the quantity demanded. So again, folks, pros and cons is not a political issue. The obvious pro is if you can find a job, you are going to get paid a higher wage rate. The problem is, though, at that higher wage rate, there are not going to be as many job opportunities. So there's good news and bad news. So the quantity supplied of the labor at that artificially high wage rate is going to be above the quantity demanded for labor at that artificially high wage rate, okay? Because they set that price above the market clearing price, okay? So that's going to create what? A surplus of labor. And unfortunately, people who have a job, that's great, they'll make more money, but unemployment may unintentionally go up. They didn't want to make people unemployed, but unemployment may go up. So pros and cons at your job. When would a price floor be ineffective, folks? If they put it below. If the price floor were down here, you mean I could have made $10 an hour, but now you tell me I'm going to make $5 an hour? You haven't done me a favor. All right. So if they put it below the market equilibrium price, then they've done nothing. That would be considered ineffective. So this is part of the beauty of what they do, folks. If your supply is greater than your demand, you know you have a surplus. Okay. So anytime your supply is greater than your demand, you're going to have a surplus. What happens anytime there's a surplus of anything? Prices are likely to go in what direction eventually? Down, to clear it. Anytime your demand is greater than your supply, you're going to have what? A shortage. All righty. So what I want you guys to understand is now shifting. If all we have is a change in price, I mentioned the lines don't shift. Okay. Step number one is the interaction. If the government is not involved, the interaction of supply and demand will set the price. Okay, we'll set the price without any government intervention. That's our equilibrium price. Okay, as you can see there. All right, now if all we have is a change in price, if all we have in the facts exam day, if all we have is a change in price, there's no shifting of the line. As I just showed you, all we do is slide along that existing line. Okay, so as price goes up, well, you know what? If I could sell at a higher price, quantity supplied goes up, but the quantity demanded is going to slide down. Conversely, if the price goes down, okay, if your price goes down, then the quantity supplied at that low price, I'm not going to supply as much, but the quantity demanded will go in what direction? Up. That is the concept of sliding along the existing line. All we have is a change in price. But when the line moves, if the line, quote unquote, the supply or the demand line moves, it shifts. That is due to something other than, change in price of that good or service today. All righty. So folks, anytime we have a shift, if they tell you we shift left, I don't care if it's supply or demand. Anytime either line shifts left, there will be smaller supply, smaller demand. All right. Anytime we shift left. Anytime they tell you a line shifts to the right, well, anytime we have a line that shifts to the right, more supply, more demand. But now what I want you guys to do is understand what a change in supply or demand will do to change in price. So folks, if we have a shift left, folks, what happens when your supply goes down? Well, if it's a really, curtailed and you don't have a lot of it and there's a shortage, prices are going to go up. Think about when people don't want a good or service anymore. When the demand shifts down, shifts left. What happens when there's no demand for something? The price is going to go in what direction? Down. If people don't want to buy it, prices are going to go down, obviously. When you shift to the right, folks, there's all of a sudden a bumper crop. the supply of this commodity goes way up. Well, there's a surplus. What happens when there's a surplus? Price is going to come down. What happens if all of a sudden technology changes, taste change, demographics change? Think about Roger. Roger's got to be about 72 now. There's lots of people like Roger. These baby boomers are all over the place. They're moving to Florida. They're moving to, where are they going to? I want to say Arizona. What's happening to the prices of those homes up there with all that demand up? That makes that price go in what direction? Up as well. Come on, man. That makes the price go up. All righty. So you need to think about the line shifting left or right, what that does to price and what that does to quantity. And it's as easy as that. All right. So, and that's due to something other than change in price. Here is the beauty of the UWorld product, folks, other than the instruction and the phenomenal writers who put the course together. It's the way they put the answer choices together, the explanations for all the answer choices. So they talk about the general rule, prices, quantity supply, quantity demand. There's your level of equilibrium. The governments don't interfere. We're in good shape. There's no shortage. There's no surplus. Okay, we're going to sell all of their output without a shortage or a surplus. But then they tell you, hey, anytime they throw in a price ceiling, all right, so they put in that price ceiling, they want to keep the cost of apartments down. What's that going to do? Well, if they put it below the natural equilibrium, then it will be effective. But what's going to happen though when they lower the price for apartments? There could be what? A shortage. And then they talk about, like I did, well, what if they set a price floor, a minimum wage? That's got to be above that equilibrium point for it to be effective. Well, then you know what? Lots of people want to work at that wage rate, but not a lot of companies are going to pay that. That could create a surplus. And then they remind you of the key points illustrated in that question. One down, 4 billion to go. Let's go. Let's try another one. All righty, which of the following characteristics represents an advantage of the internal rate of return technique over the accounting rate of return? Stop right there. If we're talking about IRR, that is based on what? Cash flows. Why do we like to base decision on cash flows? That's objective, not effective, not affected by methods of accounting or estimates. At the end of the day, I'm going to buy an investment if it's going to add value, it's going to add income, if it's going to add to my net worth. And how much is that going to add? Well, IRR doesn't tell you the exact dollar amount, but what it does tell you is, hey, if your return is greater than your required rate, well, then you can infer value is being added to that business, to your net worth. All righty, so we're looking for IRR being greater than our required rate. Now, what's your required rate of return? Well, for our purposes, that's mostly the company's weighted average cost of capital. As a general rule, for projects of typical average level of risk, they need to get a return on invested capital greater than their cost of capital. It's simple. If you borrow money at, let's say, 5%, and let's say the interest is tax deductible, and let's say your tax rate is 30%, well, you know what? Then government is picking up 30% of the cost of the interest. Your share of the cost is 70% of that 5%. Your hurdle is 3.5. If you can confidently take that money and invest it above your hurdle, well, you know what? That's going to add value to your net worth. And that's what we're all looking to do as investors. But we like IRR because it's based on cash flow. It's objective. All right. It also takes into account time value of money. Look, if you tell me, hey, Pete, lend me $10,000 and then in 10 years, I'm going to give you back $11,000. Well, I have an extra $1,000 of profit, right? No, I don't think so, because I ain't getting that money for another 10 years. The purchasing power of money generally goes down over time. The concept of inflation, when there's a rate of inflation, you've got to make sure you're getting reimbursed for your loss of purchasing power. So we need to understand the time value of money. And it's not just about your loss of purchasing power. If I give you my $10,000, well, I can't use that money to take a vacation or to buy something with. So I also want to be compensated for deferring consumption to the future. That's called the real rate. The price you charge, nothing to do with inflation, nothing to do with risk. Just look, if you want my money and I can't use it, I want you to reimburse me because I lost my opportunity to buy something today. All right, that's the real risk-free rate. So look, you want to make sure you're getting compensated for deferring consumption, your loss of purchasing power, and then shit, how do I know you're going to be around in 10 years to give me my money back? I also want to be compensated for assuming risk that you might default and never pay me my money back. IRR is a way to look at, well, whether or not we expect to get a yield above and beyond that hurdle, okay? So that's why we like IRR. Now, accounting rate of return. What's the problem with accounting rate of return? It's based upon what? Accrual basis net income, accrual basis cost of that investment on your balance sheet. Folks, that's skewed by methods of accounting, estimates, straight line depreciation, accelerated depreciation, useful life, salvage value. So I don't like it because it's based upon subjective accrual basis amounts, whether it's the income statement or the balance sheet. Both of those financial statements are skewed by management because they're biased. They're going to choose methods of accounting that may make them look better than they really are. That's why in the real world, we always want to look, yeah, I see your accrual basis earnings, but are you actually generating that in cash? That's why we have the statement of cash flow, because ultimately, if you're telling me you have this income on your income statement, I'll have more confidence in that number when I actually see the cash being generated on the statement of cash flow. Lots of companies that go bankrupt and do things illegally or unethically or are very aggressive and not doing anything illegal or unethical, but are very aggressive, their accrual basis earnings might be nice and high, growing at a very nice rate. But if I don't ever see the cash being generated, then you know what? I'm not going to believe that accrual basis net income number. Plus, accounting doesn't tell me about time value of money. It doesn't compensate me for that loss of purchasing power and that default risk and all that kind of good stuff. So IRR, we're looking for advantages. All righty. So we know for sure the emphasis is on cash flow. Yeah, cash flow is more objective, no doubt about it. That's why we like IRR over accounting information. Recognition of the time value of money, absolutely. We got to consider that when we determine our hurdle rate, our required rate of return. That is relevant. That's an advantage of IRR over accounting rate of return. But what about salvage value? Do they both consider salvage value? They do. Your accounting rate of return as well as IRR, they both consider salvage value. So that is not an advantage of IRR over accounting rate of return. Salvage value is considered by both. In accounting, we know that that's salvage value. In accounting, you've got your cost minus that salvage value divided by your useful life. The higher your salvage value, the lower your depreciable base. The lower your depreciable base, the lower your depreciation expense. The lower your depreciation expense, the higher your accounting profit. So salvage value is going to affect your accounting profit. But does it affect your cash flows? You bet it does. When you do IRR, you've got to look at your initial investment, your cost. Your initial investment, your cost. You enter that negatively. That is an outflow. All right, so you enter that negatively. That's your outflow. That's your hurdle in dollars. Then we look at our annual operating cash flows. If I make this investment, what's going to be my annual operating cash flows? That's an annuity. That's a regular payment we're going to receive every year for the life of this investment, assuming it's an equal payment. You enter that positively. That's an inflow. And then you've got your one-time terminal year cash flow. What is your one-time terminal year cash flow? Well, that's your inflow, your salvage value, your selling price, net of tax. So that's considered in both the calculation of IRR as well as your accounting rate of return. IRR is the single discount rate, that sets the sum of the present value of these future cash flows, these future cash inflows, equal to today's cost. Equal to today's cost. There is today's cost. So in essence, IRR is an estimate of yield. Hey, you know what? If you spend this money to buy it and you get these inflows in the future, here's your rate of return given what you paid for it and what you'll be getting in return, just like with a bond. A bond's yield, when you solve for a bond's expected yield, its yield to maturity, hey, if you pay this price for the bond, and you get all these coupons as well as that principal at maturity, well, guess what? This is your expected yield given what you paid and what you're getting back. That's what IRR tells you, okay? So choice C, we like IRR and NPV. IRR and NPV have a lot in common because primarily they're based upon cash flows and they consider the time value of money. That's why we like IRR and NPV, all right? Very objective. Now, IRR I've mentioned, what is NPV? It's your profit or loss that is expected in absolute dollars. IRR looks at yields, your expected yield versus a required return. It looks at the spread. Like you might have an expected yield of, let's say, 30% versus a required rate of return of 12. And you're saying, hey, that looks like a really good investment. What's your spread? What are you going to earn on that? 18%. You know what you don't know with that calculation, though? How much am I adding to my net worth? I have no clue. All I know is I'm earning 18%, but it doesn't tell me in absolute dollars the value I'm adding to my net worth. What I can infer, though, is anytime your IRR is greater than your hurdle, you can infer that you have what's called a positive NPV, but you do not know the value you're adding to your net worth. NPV tells you in absolute dollars the value you're expecting to add to your net worth. It's the sum of the present value of the future cash flows minus today's cost. That is your NPV. Folks, if that is positive, you think you're going to have a profit. If it's negative, you reject it, you're going to have a loss. All righty. So sum of the present value, the future cash flows. What are your future cash flows again? Your future cash flows, your cash flow from operations, and that one-time terminal year cash flow. Okay, those are your expected cash flows. Discount those back to today. See if the sum of the present value of those future cash flows is greater than today's cost. All righty, that's how you calculate your NPV. Tells you in absolute dollars the value you're adding to your net worth. Now, another major difference between IRR and NPV, the cash flows you're getting over the life of that investment, you got to remember for the exam, NPV takes a more conservative approach. They say, hey, any cash flows you get during the life of this project, they'll merely be reinvested at your discount rate, your hurdle rate. IRR is more aggressive. IRR says, no. Any cash flows we get during the life of this investment, we will reinvest at this project's IRR. Very aggressive. That's why bonds in the real world rarely earn that initial yield to maturity that you forecast when you buy the bond. Because that IRR, the only way you're going to earn it is if every coupon received over that life of that bond is reinvested at that initial yield. And that's highly unlikely. You're going to be investing that cash flow. God only knows what rate of return you're going to get. Okay. So NPV and IRR is a relative measure of success. It looks at a spread between your required rate of return, a relative measure of success. NPV, absolute measure. All righty. Now, when you calculate your future cash flows, you want to take your EBITDA times 1 minus the tax rate. What's relevant for decision making is before financing costs, but after tax. Before financing costs and after tax. There is your cash flow from operations, unless they tell you, hey, you know what? You've got depreciation that's tax deductible. Even though depreciation's a non-cash expense, why would we consider it with NPV and IRR? Because of the dollar value of that depreciation tax shield. If depreciation is tax deductible, the depreciation times the tax rate, folks, that's going to save you money. So let's say your depreciation is $100,000, your 30% tax rate, you're going to save $30,000 because the government is picking up 30% of the cost of that depreciation. It has a lot of value. That increases your cash flows because that reduces the tax you have to pay to the government. So this is how you get your annual operating cash flows, assuming we are considering taxes. Okay, there's your annual operating cash flow. And what's relevant? before financing costs, because we will consider the method of financing this investment. We'll consider that in our discount rate, our weighted average cost of capital. We don't want to double count the effects of leverage. So it's earnings before the interest, but after tax, okay? So government takes their share. You got to make sure you consider what you put in your pocket versus what you have to give to the government. That's the bad news, because some of your profit goes to the government. The good news is, well, at least if you get a deduction for the depreciation, that puts more money in your pocket. There's your annual operating cash flow. All righty. Now, next item, by the way, accounting rate of return. How do we get accounting rate of return? If they ask for that, find me the average net income over the life of the investment, over the life of that project. So add up the net income generated each and every year, 5 years, take the net income, add it up, divide by 5. And then you divide by the average book value of that investment. That's just going to be the beginning book value plus the ending. And folks, if you fully depreciate it and there's no salvage value, your ending book value would be 0. But if you have a salvage value, then your ending value would be your salvage value. Your beginning value is your cost plus your ending value divided by 2. There's your average book value. Okay, there's your average book value. And folks, your cost is not just the invoice price. It's invoice plus shipping, plus installation, plus that initial training to get your people ready. All costs ready to get that asset ready for use. Love this chart here. Folks, if you obviously look at your payback period and your discounted payback, which I haven't spoken about yet, other ways to assess an investment, should I do it or not? How long till I get my investment back? So folks, if an investment costs you $1 million, I need to know, how long is it going to take me to get my $1 million back? Okay, so this is a focus you got to remember on the exam. The focus is on liquidity, which is relevant, folks. That is relevant. Focus on liquidity, because you got to make sure you have enough cash that you could service your obligations when they become due. So step number 1 when analyzing any investment is to make sure you'll get your money back in time to service your obligations. Now, discounted payback has an advantage over payback, because payback by itself means it's undiscounted. I want to take into account the time value of money. That's an improvement over just a regular discounted payback, undiscounted payback, okay? And the discounted payback period, discounted, is always going to be longer than the undiscounted. Why is that? Because the cash flows when you discount are smaller than the cash flows when they're undiscounted. So your payback period is always going to be longer discounted versus the undiscounted. But it focuses in on liquidity. How long till I get my money back? Okay, net present value in absolute dollars, the value you're adding to your net worth. So unlike IRR, another advantage of NPV is not just the conservative reinvestment rate, but folks, you got to understand and remember on the exam, NPV allows you to discount your future cash flows at a variety of different rates. IRR, you're locked in to your expected yield versus one hurdle. You can't have multiple hurdles, one hurdle. NPV says, wait a second, a cash flow coming in a year probably has a lot less risk than a cash flow coming in 10 years. So on the exam, NPV has another advantage in that it allows for flexibility. You could change your discount rate. So a cash flow coming in 10 years might be discounted back at a higher rate than a cash flow forecasted to come back in just a year from now. So it allows for multiple discount rates. Okay, NPV and IRR, both focusing on the time value of money. What's your discount rate? Your hurdle rate for projects of typical risk. That is generally your weighted average cost of capital. NPV, you can adjust. IRR, you're only allowed one discount rate. That's it, one hurdle rate. Okay. Now, let's see. Yeah, so good stuff there. So again, look at the detailed written explanatory answer. Fantastic. All righty. Remember, on the exam, major limitation of NPV is you don't know your yield. You don't. You just know if you're expecting to make money or lose money. IRR, you can infer that if you have a positive NPV, your IRR is greater than your yield, but you don't know your IRR unless you calculate it, which is not difficult to do. Okay, so you could calculate your IRR. But the key is NPV tells you in absolute dollars, IRR is a relative measure of success, okay? Now, when you have an unlimited budget, you have enough money to fund all worthy investments. NPV and IRR are going to give you the exact same recommendation, reject or accept. You could use either one. Okay, but when you have a limited budget, there's a cap on what you can spend. And now you got to rank your investments. You may get a different ranking, NPV versus IRR. You may get a different ranking NPV versus IRR. They do not necessarily give you the same ranking. And a lot of that has to do with the presumed reinvestment rate. NPV assumes you can reinvest only at your hurdle. IRR is more aggressive and says, no, those cash flows we get early on are valuable because we can reinvest at this yield, okay? So you may get a different ranking. You got to take a holistic approach, as we'll see in a task-based simulation in just a little bit. Oh my God, time is flying. You got to be kidding me, man. All right, let's try another one, and then I want to do a task-based simulation. My goodness gracious. You ready? Folks, if this were the exam, please do not start reading up here with Para Company because you have no idea what to do with those facts. You know the deal. You start with your question stem, legalize cheating. I want to know what to do with all these facts before I read the facts, so I don't have to read the facts, not know what to do, read the question, figure out what to do, and then have to go back and reread the facts. We're not going to let that happen. So they tell us, they want to know, hey, what would be the annual savings needed to make the investment realize a 12% yield? All right, now I'm going to read the facts. We're forecasting a yield of 12%. What methodology gives you a forecasted yield? IRR. So IRR is saying, hey, you're going to get a 12% yield. What is 12%? Well, if you pay this cost and you receive these future cash flows, you will earn 12%. You will earn 12%. 12% again is that single discount rate that sets the sum of the present value, the future cash flows equal to today's cost. Now you see, you think you know the rules, and then they test it backdoor way. This is what I love about the way UWorld set up the questions, because we want to cover it from a variety of different angles. Sometimes it's very straightforward. Sometimes it's not as straightforward. And a lot of these questions, you know what, we look at, where the CPA exam, like where they're getting their questions from and their content from, old questions. We also look at, the popular textbooks that are used in college, because the folks who are writing the questions for the CPA exam, more often than not, are college professors. It's not a lot hard to forecast what type of questions they're going to give you. Theory-based, math-intensive, straightforward, backdoor, all that kind of good stuff. So this is one of the common tricks. They tell us, we got a cost of $50,000. So folks, if my cost is $50,000 and the sum of the present value, the future cash flows is discounted at 12%, well then you know what? The present value, the future cash flows is going to equal what amount? $50,000. If we use 12% of the discount rate, then the sum of the present value, the future cash flows will equal today's cost. So they tell me, here's my hurdle in dollars. Okay, they tell me I'm expecting a residual value in 5 years. What's the term of this investment? 5. That's when we're going to sell it off. They gave me the discount rate for 12%. What's an ordinary annuity? You use that as the discount rate. You use that as the discount rate for your annual operating cash flows. That's an annuity. Multiple payments of the same amount is an annuity. So multiple payments of the same amount, you use your annuity factor. You use your annuity factor. All righty, so our annuity factor. All right, so I don't know what that payment is, but if I multiply it by 3.60, that's part of the sum of the present value of my future cash flows. What's the other piece? My one-time terminal year cash flow. One-time terminal year cash flow. What's my one-time terminal year cash flow? Well, they tell me in 5 years, you're going to sell this off $10,000. That's one time. So you use the present value factor of 1. It's a one-time future cash flow. So my one-time terminal year cash flow is given information, $10,000. And folks, in this question, no tax rate is given. When they do not give you a tax rate, you don't have to worry about depreciation, and you don't have to calculate anything after tax. If they don't give you a tax rate, you totally ignore depreciation. There's no dollar value of your depreciation tax shield without a tax rate. So you can forget depreciation, and you don't have to convert your cash flows to after tax. So it's just my $10,000 times a single cash flow coming in 5 years, discounted at 12%, 0.57. Well, that amount is $5,700. And here's the sum of the present value of the future cash flows, $50,000. And that's 5,700, 5,700. If your IRR is 12%, that is the single discount rate that's setting the present value of these two cash flows equal to today's cost. So you know what I could back into then? What's got to be the present value of my annual operating cash flows? Well, the present value of your annual operating cash flows then has got to be $50,000 minus $5,700. What's got to be the present value of those annual operating cash flows? Got to be $43,000. It's got to be, because the sum of the two have to be what? $50,000. So your annual savings, folks, that's your cash flow from operations. Sometimes you make an investment, you replace an old piece of PP&E, not because it's going to increase sales in so much as it might be more efficient. So if your costs go down, your operating cash flows go up. That's your incremental cash flow. That's what's relevant. So folks, that cash flow from operations, what's that got to be? I don't know. Well, my payment times 3.6 though has got to be $43,000. Now I love this because my kids, my younger son right now is taking the algebra. Dad, why gonna make me learn algebra? Where am I going to use this in my real life? Yo, Dominoch, come down here. Let me show you where you're going to use this algebra. This is where you're going to use that algebra. So, folks, we're going to divide both sides by what? 3.6 and isolate that payment. 43,000 divided by 3.6. 44, excuse me, and that should be 44,300. I can't add or subtract. I'm building your confidence. You're like, had this dumbass pass the exam? He can't even subtract. Well, if I pass, you should get a perfect score. So 44,300, divide both sides by 3.6. What's that payment got to be? Well, that payment's got to be $12,305.55. $12,305.55. Now, this is the point where if you're religious, you'll pray, I hope that's an answer choice. And whoop, I see it. There it is, C. Now, all you got to do is get the P and the A, and we're in good shape. But that's how you back into it. You see how sometimes it's not as obvious, but this is why you got to practice a variety of questions. And this is the beauty of multiple choice, is that you can attack a topic in a lot of different ways: math intensive, theory based, straightforward, backdoor, all that kind of good stuff. Okay. So your annual operating cash flows, your savings have to be 12,306 approximately, because if you multiply that by the present value factor of an ordinary annuity with a term of 5 years and a rate of 12, you get the necessary 44,300, because an IRR of 12% sets the present value of both of those future cash flows equal to that cost. And if you pay that 50,000 and you get these future cash flows, you're going to earn 12%. But if and only if every single year during that 5-year investment, you actually reinvest your cash flows at what amount? 12, not more, not less. You'd have to reinvest at exactly 12. All righty. So not so bad. Now, are we going to accept or reject this project? I don't know, because I do not know my hurdle rate. IRR needs to be compared to your hurdle rate. So folks, if your hurdle rate was N, I have mental health issues, man. N, what does that have to do with 8%? I don't know. But nonetheless, with an IRR of 12% and a hurdle of 8, well, then you know what? Yeah, I would want to do this deal. The problem is I don't know what kind of value I'm adding to my net worth. I just know I'm getting a spread of 4%. And then again, here's our beautiful detailed explanatory answer. It's not just a check, hey, C's correct, good luck with A, B, and D. No, no, no. Why is it correct? Going through the details. All righty, so this explains all those details beautifully to you. All right, now remember, to calculate future cash, to take a future cash flow and discount it, if it's a one-time cash flow, get me the present value factor of a one-time payment. When it's your cash flow from operations and assuming every year you have the same amount, that is an annuity. Get me the present value factor for an ordinary annuity. What's an ordinary annuity? You're expecting that payment to come at the end of each year. Just be careful. If they mess with you and tell you the payments begin immediately, starting today, your first payment and every payment thereafter is not December 31st. No, no, no. It starts today, January 1. Then you need the present value factor of an annuity due, because each payment is coming at the beginning of each period, the beginning of each year, not at the end. All righty, beautiful. Come on, man, you got to be kidding me. Time is flying. Jeez. All right, this is what I want to do now. You see how, they could test this with multiple choice. How could this be a task-based simulation? So here's my recommendation, folks. You go through your course. Hopefully you're using UWorld, whatever you're doing, though. You go through your course, you're watching your lectures, you're reading, that's great. But step number one is to apply that to the multiple choice, because the multiple choice covers a lot of ground and it's going to reinforce your understanding of the topic. Do not attempt task-based simulations until you have a firm grasp of those key issues. Now we're going to take this knowledge and we're going to jump ahead. By the way, here's a quick view of all the questions I'm going to do next time. Yep. There it is. Look at this beautiful stuff. Beautiful, beautiful, beautiful. Next time we're going to have 2 hours, not an hour. An hour? What can you do in an hour? And there's a beautiful task-based simulation we're going to do next time. Here's the task-based simulation we are going to do today. Next time we'll do absorption costing, variable costing, all that good stuff. So what we're going to do now is this task-based simulation right here. So folks, when it comes to a task-based simulation, even if it were an open book test, it would be challenging because of the volume of information that's thrown at you. That's why it's so important that before you rush and try the task-based simulations, you have a good understanding of the subject matter. So step number one with the task-based simulations, you ready? Do not read these facts. I have no idea what to do with all this crap. I don't know what's relevant, what's irrelevant. Legalized cheating. What do they want me to do? Well, I see I got this exhibit here. They're talking about all these different investments, A through E. They're talking about net present. Oh, I see. Okay, now I understand. Net present value, IRR. Now I got to be thinking, how do I calculate NPV? Sum of the present value of the future cash flows minus today's cost. IRR, today's cost. And then what are your future cash flows? That's the single discount rate, right? We want to compare that to our hurdle. All right, I see. They tell me the net present value of the safety equipment. All right, safety equipment is $200,000. Well, is that correct or is that incorrect? Is it something other than that? The payback, oh yeah, what's my payback period? Then I stop and think, oh yeah, payback. My cost, what I paid for it. And now if I have annual operating cash flows, this will tell me how long to recoup that cost. That's relevant because it focuses in on what? Liquidity. You can't ignore that, folks. You got to make sure when you make investments, you don't take so much out of your savings that you have nothing available to pay your rent, your insurance, your utilities, right? You got to make sure you're going to be getting cash flow in time to also service your debt in addition to making this investment. So that's one way to calculate your payback period, but that's if and only if you have annual operating cash flows that are the same. Otherwise, you're going to have to go through it 1 year at a time and accumulate over time enough cash to recoup that cost, okay? What else do they give me? Hey, should we do this machine shop project? I don't know. Well, based upon IRR. Oh, yeah, I'll do that deal so long as the IRR is greater than what? My hurdle rate. Okay, so you're setting yourself up, that legalized cheating and more of the same, all that kind of good stuff. What else did they tell me here? There's a new regulation that goes into effect. Without additional safety measures, the acid wash department will have to discontinue operations. So stop right there. Most of the time, we make an investment to get our sales up, to get our cash flows up, to get a positive NPV or IRR greater than your hurdle, your cost of capital. Sometimes we're looking to reduce our expenses to get our cash flows up, to get a positive NPV or an IRR, again, however you want to measure success. But sometimes projects, you got to make an investment, but there's no change in future cash flows sometimes. Why? Because if you don't make the investment, you're out of business, legal or regulatory. So look, if we don't set up legal or regulatory, this is another reason sometimes companies undertake investments. Legal or regulatory, they either have to do it or shut down. Now, you might want to shut down, but if you can make the investment in the legal and regulatory, right, you can make that investment, and then the future cash flows, because you continue the investment, exceed the present value of those future cash flows, exceed that investment you got to make in the safety, well, then make the investment in the safety, but only do it if it's going to give you a positive NPV and IRR greater than your cost of capital. Otherwise, you might be better off shutting down using this methodology to assess investments. Here is that acid wash department. Here's the facts they give us. You already got an investment of $2,000. That's your historical cost. Guess what? That is also known as a sunk cost. That is irrelevant when making decisions using NPV or IRR. NPV or IRR looks at incremental cash flows. Incremental cash flows. Some costs are ignored. Cost of a study, cost of R&D, historical, it's irrelevant. You look at your incremental cash flows, either going up or going down. What else is relevant? After tax, but before financing cost. What else is relevant? Cash flows, not accrual basis net income. Not accrual basis net income. So we want to calculate our cash flows. If there's a tax rate, you want to calculate your cash flows after tax. If there's a tax rate, then we will consider the dollar value of that depreciation tax shield. When you sell that investment someday, that salvage value, that is net of any gain, any tax, net of any tax on a gain or a loss. All righty, so you want that salvage value, assuming there's tax, net of tax. All righty, now we'll see if there's a tax rate or not. So depreciation, they give us, salvage value, they give us, anticipated amounts. I guess if we don't close it down, what are we going to get? All righty, what are we going to get? Here's what we'd have to invest. This is your hurdle in dollars, your hurdle in dollars. This is what we'd have to invest to get those future cash flows if we don't shut down this acid washing business, whatever the hell that is. Here are my present value tables. Present value of 1, you use that to discount a single future cash flow. Present value, come on, man. Turn the page. Let's go. There you go. Present value and annuity. You use that to discount annual operating cash flows of the exact same amount. So that's what you would use that for. And then what else do they tell us? You guys had a cup of coffee or a Red Bull? Here's another exhibit. They give me all these investments. They tell me what the IRR is. I need to look at that relative to the hurdle rate. All right, so let's see. They give me net present value for the projects, NPV. You only want to do an investment where you have a positive NPV. All right, anything with a negative NPV we'll reject, so we'll see more of that in a second. All right, and there's our detailed explanatory answers. So let's go back, let's bang this out. So you've done your legalized cheating, you get a feel for what the topic is. Now here we go. Major manufacturing is going to receive a windfall of this money. 3.5 million is not earmarked for taxes, dividends, or investments. So folks, here is their budget. This is what they have available to invest. Now I need to know, is that a hard cap or could they exceed that if they have a lot of worthy investments? Well, they tell us shareholders are not eager to either for an increase in dividends or debt. Money not used for investment will be distributed to shareholders. Okay, so look, they're not looking to take on new debt. Okay, they don't necessarily want the $3.5 million as a dividend, so long as you can invest it and add value to the company, add value to the stock price. They don't mind you retaining the earnings, but they don't want to take on any new debt. All righty, and they don't say anything about issuing more shares of stock. So this is probably going to be a hard cap. They can't spend more than $3.5 million. Okay, and we don't mind foregoing a dividend. That's okay. It's okay to retain earnings so long as you have an investment that will add value. And how do we determine whether or not an investment's going to add value? A positive NPV, the sum of the present value of the future cash flows greater than today's cost. Or another way to look at it, is it going to get a yield greater than your hurdle? All righty, they tell me generally the hurdle rate is 10%. Notice they use the word generally. Sometimes projects that are atypical may have a higher rate of return because they're riskier. But as a general rule of thumb, that's probably their weighted average cost of capital. For projects of typical risk, average risk, generally your required return, your hurdle is your WACC. All right, so IRR, we're gonna only do an investment if we get a return greater than 10. For NPV, 10% will be the discount rate when we find our present value factors. Your present value factors, you need two things, the term and then the rate. The discount rate is 10%. Don't know the term of any of these investments, okay? Now, if we have unlimited capital, NPV and IRR will give you the exact same recommendation, accept or reject. The problem is when you have to rank investments, when you have to rank, NPV and IRR may not give you the same ranking, may not give same ranking, all right? So then we need to know, well, what are you going to do? You got to take a holistic approach, folks. As a general rule, all other factors being the same payback period, same cost, all that kind of stuff, then you're probably going to lean towards NPV because it tells you absolute value, the dollars you're adding to your net worth. So assuming we have the same payback period, same cost, but a different ranking, NPV and IRR, probably lean towards NPV because of the value added in dollars, okay? Because IRR, it sounds great to make 18% on your money, but what if your investment is limited to $10,000? I'd rather make 12% on $1 billion than make 18% on 10,000, obviously. So IRR ignores the size of the investment, the dollars you're adding to your net worth, but a holistic approach. All righty. So Miles, the accounting staff CEO, let's see, talks to Alice, compare the investments. We're going to rank each of them. And what are they focusing in on? The hurdle rate. Okay, that's fine. You know, you don't have to exclusively, you could use NPV. They're going to focus in on IRR. Unfortunately, the accounting staff could not finish. They don't have the information for Project D. So Project D, we're going to have to calculate NPV and IRR, okay? So they're unsure how to complete it. Said, hey, look over these documents, help her out, blah, 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 blah. All right, so here we go. So they tell me, here are my investments. I got 5 investments. Okay, with a hurdle rate of 10%, the machine shop looks good, 20 greater than 10. Replace the press, 30 greater than 10. Replace the forklifts, 15 greater than 10, smaller spread, but still greater. Upgrade the safety equipment. Well, that's got an IRR of 25, hurdle of 10. Solar, this one we're going to reject. That is below our hurdle. So E, we are going to reject. Negative NPV, IRR, less than your hurdle, we could forget E. E's going away. What we don't know is the NPV for Project D. We do not know that. All righty, so we're going to take a holistic approach when we look at the ranking. So my hard cap again is how much? $3.5 million. $3.5 million. All righty, so do we have enough money to afford all of these worthy projects? Well, all of the worthy projects, let's see, we want to definitely do B, A, and let's see. And then, well, D, I don't know the NPV yet, although it's got 25 over 10. I'm not 100% sure. So we got to see what the NPV is going to be on that before we make a decision. So we're definitely going to do A and B because they got really nice NPVs. The question is, what about C and or D? Not sure yet, need the NPV on D before we make a final determination. Okay, we also have payback period. All things being equal, all things being equal, shorter term preferred. It makes the company more liquid. Why is that so important? Because you're going to have enough cash to pay your bills on time, to pay your bills on time. In the real world, there's something called matching the duration of your investments with your liabilities. You got to make sure, if you're a bank, you want to take people's money, put it in the bank, and you want to invest it, you got to make sure, bank, you're liquid enough so that if somebody walks in the door and wants their money, you have enough cash on hand. Any business to avoid bankruptcy has to make sure they're liquid enough to service their debt as if they become due. They got to avoid that short-term risk of distress or minimize it. So payback period is important. So all things being equal, B, I like it a lot. Okay, C, 5, D, we don't even know yet. We're going to have to find the NPV for D, and we're going to have to find the payback period so we can choose between C and D. All righty. So next item. Hey, they want to know, what's the net present value of the safety equipment? Okay, is that $200,000? Okay, now we're going to focus in on the safety equipment example. I want to know sum of the present value, the future cash flows, minus today's cost. What is that NPV? And I remember from legalized cheating that my hurdle in dollars was $200,000. That's not your NPV unless the sum of the present value future cash flows happens to be 400. Then 400 minus 200 would be your NPV. But I know that's my cost. Okay, so let's solve that one first. You ready? So let's go to our facts for that particular project. All righty. So project D, that's that safety equipment. Okay, so is the sum of the present value, the future cash flow greater than that cost? Well, here's my facts now. You ready? So here are my forecasted future cash flows. Here's my forecast future cash flows. This is being forecasted January 3rd, 2000. This is what I think is going to happen in 2001. This is what I think is going to happen in 2002. Capacity, here's my good news. Sales dollars versus my cost of goods sold. All righty. So very simplistic, folks. This sales less cost of goods sold is your gross profit. It's our EBITDA. It's our EBITDA. All righty. No tax rate has been given. There's no tax rate given. So we're going to ignore the dollar value of the depreciation tax shield. When no tax rate is given, when no tax rate is given, ignore depreciation. Why? It's a non-cash expense, and you cannot calculate the dollar value of the depreciation tax shield. You can't. You don't have a tax rate. So we ignore depreciation. Okay, depreciation is only relevant. It's only going to be relevant when they give you a tax rate. All right, so I need to find the sum of the present value of these future cash flows. So this is a one-time cash flow coming at the end of year one. I want to discount that back to today. The 59, I'm going to get 9 payments of 59. That's coming in years 2 through 10. So this is a one-time payment, one time, whereas the 59, 9 payments. Now I need my discount rates. All righty, now I need my discount rate. So here we go. The 45, what is my present value factor for a single cash flow coming at some point in the future? Well, let's see, 10% is my hurdle rate. That's going to be my discount rate. This cash flow is coming in 1 year from now. So my discount rate is 0.9091. So multiply that by 0.9091. All righty, 0.9091. All righty, then you've got your cash flows, 59, 9 payments. Now I need my present value factor of an ordinary annuity. So there's my annuity. I got the exact same cash flow. What was it? 59. I got how many payments? 9 payments coming of 59. Years 2 through 10, 9 payments. So I'm going to go down my number of payments and across to my hurdle, 5.759. Alrighty, 5.759. So I'm going to discount that back, but notice I can only discount it back. I can only discount back to the end of year 1. These are the payments that begin in year 2 and go through the end of year 10. I can only discount them back to today. Okay, year 1, I can't discount it back all the way to today, year 0, today. Why? If it had been 10 payments, if we had had 10 payments of 59, then I would have taken my 59 times 6.1446, and that would have been the sum of the present value of those cash flows today. But folks, I can't do that. These payments don't happen until years 2 through 10, so the best I can do is discount them back to the end of year 1. So take your 59, multiply it by 5.759. What is the sum of the present value of those future cash flows? Well, that works out to be 339.781. 339.781. That is the present value at the end of year 1. All right. Payments starting at the end of year 2, 2 through 10, 9 payments. I can discount them back to the end of year 1. So now what I have to do, now you got to discount that future value coming at the end of year 1 back to today, 1 period. Now that's a one-time present value coming back 1 year. It was an annuity. It was 9 payments of 59. Okay, not 10, 9 payments of 59. We discount that back to the end of year 1. Now this single cash flow has got to be discounted back 1 more year to get the present value of that cash flow today. So that 339.781, I'm going to add that rather than discounting the 45 by itself. The easiest way to do this, the 339.781, that 59 times that 5.759. I'm going to take that 339.781, which is the value at the end of year 1, plus I'm going to take this 45 value at the end of year 1. You can discount them separately or together, same result, but you might as well add it together. Both of those are values you'll have at the end of year 1. So 384.781 is the total value at the end of year 1. Okay. Discount both of those back to 1 year, 0.9091, 349.8 is the present value today. So you could have taken the 45.9091 and then take the 339.781, multiply that by 0.9091. You're going to get the exact same result. Okay. The key is that second cash flow, that annuity stream, 9 payments, discounting back, not to today because it doesn't start to the beginning of year 2 through the end of year 10. So we can only discount it back to the end of year 1. Then you take both values that you have at the end of year 1, discount back to today. So what was our cost again? 200. So with the sum of the present value, the future cash flows of 200,000, of 349.78, 349.8, I should say, minus today's cost of 200. What is the positive NPV? 149.8, approximately 150. All righty, approximately 150. All righty. So now let's go back and answer that question. The net present value of the safety equipment is 200,000. No, it is not. Okay, if we make this investment and we spend the $200,000, what will be the present value of that future cash flow? The present value of that safety equipment, the NPV, 150,000. Now, a couple things I want to mention about this to clarify. The salvage value, it didn't say it here. It wasn't explicitly said, but I'm going to point it out. The salvage value is what you'd get today if you quit. So folks, if you quit and say, nah, I'm not going to make the $200,000 investment, then you'd have your salvage value of 50 today. No need to discount it. That's what you'd get today, minus no cost. You just shut down. You have no cost, assuming all costs are variable. Okay, assuming all costs are variable, that if you shut down today, you'd have no further costs, then your NPV would be 50. Okay, if you quit today, all costs are variable and you get the selling price of 50 today. But that salvage value is what you have today. There's no salvage value in 10 years. I want to make that very clear. There's no salvage value in 10 years. The only way you get salvage value of 50 is if you sell it today. All right, so no intent to deceive, just want to clear that up, buried in the facts, but I want to just point that out so it's explicit. All righty, so our NPV, one question done. That NPV, it is not 200,000, it's 150. The sum of the present value, the future cash flows, approximately 350,000, approximately minus today's cost, 150 NPV. One question down, lots to go. All righty, next thing. They want to know, hey, what's going to be the payback period of that safety equipment? So we got to make a $200,000 investment. We also want to try to figure out, well, about how long is it going to take you to get your money back? Okay, about how long is it going to take you to get your money back? Okay, so my cost is $200,000. I do not have the same amount every single year. In year one, I'll have 45. In years 2 through 10, I'll have 59, and no discounting required. If they just say payback, that's undiscounted. If they wanted discounted, they would have to use the word discounted payback. So since they didn't use that word, it's undiscounted. All right, so 200,000 is what I got to get back. In year one, I'll get back 45. That leaves me a balance of 155 that I got to get. Now the annuity kicks in. So that 155, well, I'm going to get 59 per year, an annuity thereafter. Now I could take that 155 and divide it by 59. It's going to take 2.62 years plus year one, a total of 3.62 years, approximately 4 years to get your money back. Approximately 4 years. And look, there's no intent to deceive, closest to. All right, they'll either give you 3.62 or they'll say closest to, round up, whatever. There's no intent to deceive, okay? It'll be very obvious. But you need all of year one, and you need another 2.62 years beyond year one, giving you a total of 3.62 years, approximately 4. Okay, now I can go back to this chart and fill in. I'm going to have an NPV of 150,000, and I got a payback period of 3.62 years. So what combination of projects do we want to do? What combination of projects? Well, we definitely want to do the press machine. Definitely want to do that has the highest positive NPV, also has the highest spread. All right, so we definitely want to do project B. So we got to keep track of the cost, $1 million, because we only have 3.5 million to spend. Drop the zeros, 3.5 million. That'll get us an NPV of 988. Okay, and also an IRR, a spread of 20, 30 over the hurdle of 10. We definitely want to do project A because that has the next highest positive NPV. That has a cost of $1.6 million, positive NPV of 944, second highest spread. So we've spent $2.6 million. Now the question becomes, can we do both? Let's see, can we do both of these, projects C and D? Well, let's see, projects C and D are $1 million. That'll take me over my budget. If I try to do both C and D and I've already spent 2.6 million, that'll take me to what amount? 3.6. You can't do it. So we got to choose C or D. We got to choose. What method did they say in the facts that they want to emphasize? IRR. Who has the bigger spread? The safety equipment. 200,000, 2,000,008. The safety equipment will get you an NPV of 150, and that has a nice spread, 25/10. And then you have $700,000 left for what? Well, after you spend that 2.8, you could take the 3,000,005 minus the 2.8, and the balance you could pay out in the form of dividends. Now, the question is, other than them telling me, why would I also like the upgrade of the safety over the forklifts? Even though the forklifts have a little bit higher of an NPV, you got to use a holistic approach. What favors the safety equipment? A shorter payback, a shorter payback. And look at the spread, +5 versus a +15 in terms of IRR, and look at the differential in cost. This is only 25, this is 800, this is only 200. You got to take a holistic approach. So the NPVs aren't all that different, $29,000 difference, but the safety equipment has a much shorter payback period, a much lower cost, and a much larger spread. The preponderance of the evidence, yeah, we're going to do that, upgrade that safety equipment. So we're not going to do the forklifts. We're going to do that safety equipment. Okay, so the total NPV would be the sum of the 988, the 744, the 150, 1882. 1882. All righty. And then the balance will pay out in the form of dividends. No one's going to be upset about that. Okay. So we've answered questions 1 and 2. Now what about question number 3? Let's take a look at question number 3. Okay, should we undertake the machine shop project, the IRR, and are there sufficient funds? So machine shop, folks, was project A. That has an IRR of 20, greater than the hurdle of 10. And did we have enough money for project A? Yeah. What projects did we say we were just going to do? A, B, and C. In the order of, we are going to do B, A, actually BAD, I'm sorry, BAD. Let me just double check. B, A, B, D, but in the order of BAD. Who's bad? So we are doing B, A, and D. So we're going to do project A? You bet we are. Okay, the IRR is greater than the hurdle, so we are going to undertake that project. Okay, so we should undertake the project. The project meets our IRR, and yeah, there's sufficient funds. We are going to prioritize that project. All right, what about the press replacement? That is project B. Project B had an IRR of 30, greater than 10. And an NPV of positive 988. As a matter of fact, when we ranked them, that was going to be the first project where you're going to do. Say, yep, we're going to do it, and there's enough money to do it. The IRR is greater than our hurdle. That's how we're making our decision, and we can afford it. It's within our budget. How about the forklift? Project C. We are doing B, A, and D. We're not doing C. Why? Even though we met the IRR 15 over the hurdle, even though we had a positive spread of +5, it had a higher cost relative to D. It had a higher cost than D, 4 times higher. Instead of 200, it was 800,000. It had a longer payback. It had a longer payback and a smaller spread, only +5, whereas D had a +15 spread. So we're not going to do the project. We're not going to undertake it. We're not. And what's the reason why? Even though we met our IRR, we don't have enough money to do it. If we had an unlimited budget and we could go over the 3,000,005, we would think about doing it. But you're foregoing dividends. You know, we got to look at that carefully, but we would consider it if we had more money. We don't have enough money, so we're not going to do it. Okay, what about the safety equipment upgrade? That was project D, where we did the math. All righty, they told us the IRR, they gave us that was 25, greater than the hurdle of 10, so we got a spread of +15, which we like. Okay, and even though the NPV of D was a little bit less than the NPV of C, it had a much lower cost, much lower. It was only 25%. This was only 200 versus the 800. Shorter payback, more liquid, which is good, reduces our risk of financial distress, and IRR substantially higher. Okay, much lower cost. Okay, and the IRR was substantially higher. Okay, and a shorter payback period, much lower cost. Okay, so yes, are we going to do it? Yes, we're going to do it, and we got enough money to do it. All right, should we undertake that solar electricity? Well, that was Project E. Project E had an IRR less than the hurdle. It was only 5, less than the 10, and it had a negative NPV. Hell no, we cannot do that. We should not undertake that. It doesn't meet our IRR. Nothing to do with money. Forget the money. We're going to reject that whether we have the money or not. It's a loser. That would reduce the net worth of this company. Okay, and there's all our facts again. Folks, the most important takeaway from this question, what was the most important, well, sorry about that, guys. What was the most important takeaway from this question? Learning how to calculate the present value of the future cash flow. All righty. The first cash flow was coming at the end of year 1. So we only had to discount that back the 1 year. The second cash flow was coming at the end of years 2 through 10. That was an annuity. We had to discount that back to the end of year 1, a payment, 9 payments, discount rate of 10%. We got the present value of those payments. And then both of those, now that they're both values at the end of year 1, now we could discount both of those back just the 1 year. Okay, that was the key takeaway. Depreciation is not relevant. It's a non-cash expense unless you're going to consider the dollar value of that depreciation tax shield. All righty. So let's see. Yeah, so those were the key takeaways. Again, the beautiful, detailed, explanatory answers provided, unbelievable. Okay, goes through all the facts step by step by step. All righty, so you don't even have to go back to the text. The beauty of these detailed written explanatory answers, rather than have to go through the hassle of linking back to the text, which we could provide anyway, we give it to you right there. Save you the time of having to go back and read it. We bring it to you. All righty. Woo, baby, I feel like I'm giving birth to a CPA. Bella, come over here. Say hello to my class. Come here, Bella. Bella, come. Say hello to my class. All right, listen, folks. This was only one event, okay? We are going to do another one September 23rd. Now, that one, again, as I mentioned, we're increasing the time. That's going to be 2 hours rather than 1. We're building endurance. The 2-hour event is going to be brand new questions. Nothing that I did in that previous one, whenever that first free one was, nothing that I did today. Okay, all brand new questions. We will also be doing 3-hour events. I'm not really supposed to be sharing this yet, but so what? 1 in October, 1 in November that are going to be 3-hour events that are going to mostly be, although it's a 3-hour time frame, going over these questions again, and maybe a couple of new ones I'll sprinkle in as well. But again, building that endurance, because exam day, 4-hour, man, you got to be able to sit down 4 hours uninterrupted. So there's the link to register. All right. And look, the 2-hour, internally, look, I could go 6 hours, and I know you probably can as well. A lot of folks who aren't sitting for the, oh man, it's too long. That's not too long. This is too quick. How are we leaving now? I'm just getting warmed up. But you know what? You got to let them know. Yeah, I like the longer event. If it pays dividends and you're not wasting my time, I like it. So let them know you like it. If in fact you like it, I hope you like it. All righty. What else we got? Oh man, all the stuff about UWorld. Look at how fancy that was. The all new 2024 review course. So I will be joining Roger and the rest of the, I can't even get to tell you. I want to go back to that slide. Amber, the whole team, I mean, is really unbelievable. There are so many wonderful instructors, PhDs, CPAs, people with real experience in accounting. If they're teaching you tax, they've done taxes, they've worked at a firm, if they're doing audit, or if they're doing any kind of, this is what they do. They special, and that's the beauty of having a team of this size, is that you got people who specialize. For me, also having the CFA, the charter, I like the math intensive stuff. It is what I do. And a lot of the financial accounting and the corporate finance and a lot of the cost of managerial that I teach in CPA, I also teach in CFA from a different angle, an analyst view. Oh, and by the way, when you're done with the CPA, come and see me for the CFA. You got to love it. I don't want you guys to be all depressed. All right, questions. My question is, why are we ending so early? I'm just getting warmed up. Bella, come over here. Don't get scared. I'm sorry I banged on the table. Come over here, say hello to my class. All right. My UWorld friends, somebody, anybody, everybody, scream. Madeline, where are you?
Hello, Pete. Thank you for this great session. I will let you know we actually had a very active team answering a lot of the questions. So we're going to keep this pretty short since we're pretty over.
We're not over.
Oh my God.
We're not
I know. There were some really good
you
questions that the team was answering throughout the session. So
Okay,
we're just going to
hold on a
answer.
second. What does anyone have to do that is better than this? I'd like to know.
It's a really good question on a Saturday. Nothing. Can't think of anything. For real.
I know, I'm serious. All right, I'm sorry. Go ahead. I got to
No, that's okay. But I do want to address an overall question that we got this time and last time. If you have an active UWorld CPA review course or an active course from the Wiley Efficient Learning for CPA review, we will be launching, as Peter just mentioned, the 2024 course materials. That is an integration of all of the wonderful people from Wiley's side. Peter, everyone will come together, and if you have an active course, we will honor that, and at that time those entities will be integrated and you will have access to the 2024 materials, including this wonderful team that Pete is showing as well. So just letting you all know, and we will honor all of that. And so then here's my first favorite question. How much is it to hire you once we pass the CPA exam?
For DJing? Oh, Matt, that's the best question I've gotten all day. All right, here's the deal. You got to fly me to wherever you are. I could bring my mixer. We're going to have to rent an amp, and we're going to have to rent speakers. I also have a light show. If you're here in the New York, New Jersey, Connecticut area, I got a beautiful light show, a truss. I got a smoke machine, a bubble machine. I got a confetti machine. Me and my 18-year-old son, he plays all the stuff that I don't know. I play the old school stuff. I don't know. We got to work it out. I don't know. Well, I'll tell you what. If you're at a major firm, any firm, top 100, or you're at a major university, here's the deal. I will DJ for you for free. But what I want you to do is go back to that firm. We need you guys. The reason we're doing this is we don't want to talk to HR partners and say how great we think we are. We want you guys to say, I took the course. This shit is great. We got to do this. You do that for me, I DJ for you for free. Let's go.
Love it. Love it. Thank you. I also want to call out, I received note that the QR code might not have been working for the BEC Boot Camp slide that came up. Everyone, no worries. That link that is in there will be sent to all of you when we send out the recording. So anyone who registered for this event will get access to the recording, and we'll also provide the link so that you can sign up for the next boot camp with unique questions, as Peter just mentioned.
And we'll be able to do twice as much as we did today because I will have twice as much time. Just mark your schedule now. Let your loved ones know. Although it's scheduled for 2 hours, you know I'm going at least 2.5 because what else do we have to do that's as good as this? All righty. So double the quantity and volume of information we got today we'll do next time. Beautiful stuff.
Wonderful. Thank you. Pete, we also got a lot of questions about written communication. I know that wasn't covered in today's boot camp, but are there any quick tips that you can provide on written communication and anything about the topics that are usually covered?
Yeah, so key thing about the written communication is if English is not your first language and this is stressing you out, you might want to consider, BEC is going away in 2024. No more written communication at all in 2024. Assuming English is your first language or you don't struggle with English and you've written essays before, read the detailed explanatory answers, what they're looking for, and you'll see we make ours on point. You can't just talk about anything. But the goal is it's identity, can you write clearly? So it's your grammar. We don't want the LOLs and all that crap. What's the issue? What's the rule? What's the analysis? What's the conclusion? You're writing to a partner, a coworker, a client, a subordinate. You want to explain what the issue is with the rule, but it's not being graded like, hey, what are the requirements to have a legally enforceable agreement? Please list them here. That's not what this is about. It's about your writing skill. It's mostly machine graded. So look, if you're taking UWorld or whoever you're taking, focus in on looking how it's set up. and the punctuation, the grammar, that's where the value is. Don't stress. I mean, look, if this is what you've been doing, it's going to be a topic related to accounting, but it doesn't necessarily have to be BEC. It could be an inventory question or whatever it is. We just want to make sure, they want to make sure that you can clearly communicate in English, okay? So read through the detailed explanatory answers. You don't have to waste a lot of your valuable limited study time writing these things out. It's graded, like I said, mostly machine graded, so you don't have to sweat this, okay? If you fight over your grade, I guess then they'll human grade it and all that kind of stuff. But I've never met anybody in my 25 plus years doing this I've never met a single person, just letting you know, who failed with a 73 or 74, paid to get it regraded, and then went from that 73 or 74 to passing. I'm sure they're out there. The AICPA NASBA freely admit the probability is like nil, all right? But you know, I guess you could have a human graded is the story with that. But look, it's not that big of a deal. Look at those detailed explanatory answers. You'll be in great shape. That's not going to cause you to fail unless English is not your first language and you're not accustomed to writing in English.
Great, thank you.
All right.
Okay, I have one content related question.
Sure.
Tracy said that she recently took BEC and noticed that there was a lot of SQL related questions, maybe a bit more than what she was expecting, and was asking if there's any suggestion on how to address these.
Okay, look, there's pre-test questions, folks. Every part of the exam, you could have 10, 12 questions, multiple choice questions that don't count towards your score. We get this all the time. I'll have people in financial say, you guys said, you know, governmental was only X% and it was like double that. Well, look, if they invest a lot of their pre-test questions bombarding a topic, it's going to seem like that's overly weighted. We, UWorld, the other course providers, we don't set that. That is by the AICPA NASBA will tell you the content specification outline. Here's the range. Now understand, if it's 5 to 15, well, it sucks if it's a topic you're weaker in and it was 15, plus there were pre-test questions on it, which then makes it seem higher than it really is. But look, you know, you go back, what I tell people the second time around is, and I don't care what course you're taking, watching the videos and reading the text is now secondary to practicing questions. So look, you don't want to go down in areas you were strong in. You got to obviously maintain that and then build up where you were weak. But primarily go to the multiple choice questions first to refamiliarize yourself with the topic, and then obviously your task-based simulations. But working the same questions from the same provider, whoever the hell that is not going to have the same value as working fresh questions. Because remember that, like that multiple choice I showed you, there's so many backdoor ways that you want to be aware of, but it's not an infinite number of ways they can test the topic, right? Get access, you know, spread out. You know, this is the beauty of having choice. And if somebody's shoving down your throat, no, you have to take us, it's exclusive, you come to our firm, you can't do anybody else. Why? What are you afraid of competition? Competition is good, variety is good, choice is good. People work harder. You need fresh questions. So if you are doing company B, get rid of the B and try somebody else's questions. It's going to resonate. Sometimes you need a different voice or a different set of questions. But focus on the questions, not the regurgitating reading of the text or watching the lectures or reworking a question where you know the answer is C because you did it 5 times. It's not going to have the same value. Okay, but focus on the question second time around.
Okay, great. Pete, last question for you. One person is asking.
I want 10 more.
I know. What did you think was harder, CFA or CPA?
CFA, only because the CPA and the bar exam are truly reviews, because you go 3 years to law school, there's not a lot on the bar exam you haven't seen. CPA, for the most part, they force you to be an accounting major. There's not a lot, few things, but not a lot you haven't seen. CFA, there's no way you could have majored in accounting, statistics, fixed income, equity, corporate finance, derivatives, forward futures, options, swaps, portfolio management, alternative investments, it's the diversity of topics. The beauty is, though, folks, I'll tell you right now, I started out in public accounting. I was at Deloitte. I was fortunate that I was able to be with a group that did a lot of acquisition audits and, you know, helping companies that were valuing. So I got to see what that background in accounting combined with the charter. Oh my God, the value, because look, finance, you want to talk about people who have a passion for accounting? Nobody has a what the hell was I saying? Nobody has a passion for accounting like the finance majors. Nobody hates accounting like they do, but sorry, suckers, level 1 and level 2 is inundated with heavy duty accounting, because how the hell are you going to value stocks, bonds, real estate unless you understand financial statements, unless you understand how to adjust the financial statements, unless you understand how to assess it to determine risk, required return, financial risk, operating risk, growth potential, what might be misleading. Relative valuation, you're comparing companies that are using different methods of accounting and you're telling me it's relatively under or overvalued without adjusting. That's the beautiful thing. So the CFA was the most challenging because each level was also like 2 or 3 parts, if not 4 parts of the CPA exam. And there was a lot of things, quite honestly, that I was learning for the first time. Obviously, my background was accounting and law. I was learning a lot of the portfolio management, but that's why I take the approach, Roger takes the approach, UWorld takes the approach. We are not going to merely read slides to you and make the assumption that it's a review, because it may not be. Look, I learned more about accounting studying for the CPA. It finally made sense to me, but don't assume I remember freaking pension accounting and how to calculate service costs. Do me a favor. I'm paying you. Show me how to do it. Now, look, it's insurance. If you don't need it, you say, hey, you know what? I'm going to do the questions first in a particular topic and say, I got 90% or above. Then you don't need to watch that video. But shit, if you're getting less than 50%, guess what? You got a lot of work to do. And now you'll appreciate that hand-holding, that not assuming you remember this from school, not reading PowerPoints to you. That's ridiculous. How do you teach math reading PowerPoints? You got to put the pen to the paper, and we got to do it together. You can't watch me on the treadmill and lose weight. It don't work that way. We got to get on that treadmill together. Isn't that right, Madeline and Rob?
That's right, Pete. I think it's a great place to end this morning or afternoon, depending on where you are. And thank everyone for joining us.
September 23rd. All right, same start time, I believe, 11 Eastern, 2 hours, planned for 7. I will see you guys September 23rd. Don't go out. Don't have fun. There's an inverse relationship between happiness and probability of passing. Madeline, did you know that? If you were to regress your probability of passing against happiness, Madeline, what's the relationship? It is perfectly inversely related. If you're going out and having a good time, you ain't going to pass this exam. You want to pass this exam? Do not sacrifice. Short-term sacrifice that'll pay you back the rest of your life. Keep your priorities straight. Never mind the gym. You'll do that when you get back. Don't take a shower. You don't need to smell good. You want to be a CPA? Be stinky. No one will bother you, and then you can pass the exam. All right, let's go.
Great advice. Thanks, Pete.
See you guys later.
All right.
September 23rd. Bye.
23rd. Bye.